2022 so far has been a horrible year for growth stocks as a whole, as prices have been hammered. So today in my portfolio update, I wanted to highlight 3 potential growth stocks you could look into and possibly add into your own portfolio or watch list. The first stock I wanted to start off with is the streaming giant that is Netflix. Over the last several years, Netflix has been laser focused on growing its global subscriber base. It wants to build a competitive moat with scale. It has been investing heavily into local language original content production worldwide. Netflix stock performance is linked to its net subscriber additions. Stay-at-home orders during COVID-19 pandemic drove business for Netflix and other home entertainment services. Consumers watched more television because movie theaters, live music, and sports were shut down due to the pandemic. But Netflix subscriber gains have slowed as the economy reopens following the pandemic. In the December quarter, Netflix added 8.28 million streaming subscribers, just missing its goal of 8.5 million. However, it edged above Wall Street's target of 8.23 million new subscribers. Since it started its original content push, Netflix has launched quite a few hit shows. They include Stranger Things, Money Heist, and The Witcher. It has also premiered popular original movies such as Bird Box, Extraction, and Murder Mystery. Recent buzzworthy shows on Netflix include the TV series Squid Games, the massive worldwide success. Meanwhile, Netflix is facing competition from traditional media companies and other services including Amazon Prime, Apple TV, and Disney+. Here are some of the cases of why you might want to or not want to look into investing into Netflix. The subscriber growth can be lumpy from time to time, and the effects of temporary slowdowns or growth spurts are magnified by Netflix's increasing massive scale. The company has 222 million paid subscribers now, and that is a 9% increase over the last 4 quarters. The management likes to point out that Netflix gets less than 1/10 of the screen time of old school linear TV in the US market. The opportunity for deeper engagement and continued customer growth is still massive. If Netflix slashed its subscription price to a flat $8 per month in an effort to compete with from a different angle, that would be a catastrophic move. Quarterly revenues from the US and Canadian market would plunge from $3.3 billion to $1.8 billion, wiping out the bottom line and kicking the improved cash flows back to the Stone Age. The company's ability to create award-winning and audience-grabbing content would evaporate immediately. I don't see how cut-rate original productions for a bargain basement monthly fee can compete with top-notch content for a premium price. Management made it clear that 2021 would produce roughly break-even free cash flows, followed by a sustainable cash profit in 2022 and beyond. That hasn't changed. Netflix consumed $159 million on the free cash flow line in 2021, which works out to a cash margin of negative 0.5%, pretty close to break even. Netflix still expects to deliver positive and annual cash flows from now on, promising to return excess profits to shareholders through stock buybacks. But Netflix stock has fallen 36% in the last 3 months and is running at a discount for any potential investors, and this could be seen as a chance to get in at a cheaper price for a company with a long runway for growth. The second stock I wanted to highlight is Meta, the tech giant previously known as Facebook. The stock is up 15% in the last week, which shows investors are getting back in at this price, but it's not too late overall. Meta is still down 33% in the last 3 months, so you definitely aren't late to the party. Meta platforms have faced several issues before, including numerous privacy scandals, regulators seeking to break up the business. None of these headwinds have stopped its progress, and it is a large part because of its user base has generally kept growing despite all the negative publicity. The business is solid and resilient, arguably because of its benefits from at least 2 related competitive edges: switching costs and the network effect. People looking to connect with family and friends via a social platform can still hardly do better to seek them out amongst Facebook's 1.93 billion daily active users, and the number of daily users across its entire family of apps which includes Instagram, WhatsApp, and Messenger, was 2.82 billion as of December the 31st. This vast network provides a solid incentive to its users to stay put, as few of its rivals can compete with it. Further, the value of Meta Platform services increases for each user as more people use them. That is the network effect. Thanks to that competitive moat, the company has at least one of the tools it will need to remain its remaining leader in its space. The company's forward price to earnings ratio is near its lowest level in over a year, and its price to free cash flows ratio of 15.9 is about as low as it's been for more than 5 years. At current levels, Meta Platform is looking like an excellent bargain, and given the tech giant's growth, opportunities and its wide moat, investors should consider holding on to its shares for the long haul. And I didn't even get into detail about the metaverse and the amazing impact that can have on the world and build its success for the company. Investors should look into Meta as an opportunity to buy into a well-established cash flow business at a discounted rate. The third growth stock I believe you should keep your eye out for is Alibaba. The Chinese giant has been on a downtrend for more than a year, weighed down by regulatory concerns. More recently, sentiment has also been negative around Alibaba stock over delisting concerns as the Securities and Exchange Commission cracks down on foreign firms that refuse to open their books to the US regulators. I've done a few videos on Alibaba and spoke on how much I believe in the company and the numbers that are coming out. But no one denies that this is a great company and that it is getting negative backlash due to outside factors it cannot control. The stock is down 54% in the last year, and many investors have lost belief and have seen it as catching a falling knife. But on the contrary, many investors still believe in the long-term outlook of this company and its massive runway for growth, and none bigger than Charlie Munger, the legendary investor himself. So Alibaba, as all stocks do, comes with its risks, and you as an investor have to decide if this is a position for you. This is just shedding light on these stocks before purchasing any positions. Ensure you do your own research and understand the company so you feel comfortable having your money in these positions and won't just sell if things turn red. Overall, this past week has been great for my portfolio. It was very pleasing to finally see some green again. Just the last week, the portfolio was sitting at $9,600 US, and today it sits at $10,330 US, up $730, recovering from its majority of its losses. This just proves that even though you might be bombarded with people telling you to sell out and move your money into all these different sectors quickly to protect your investments, but in reality, one of the best things you can do is just sit back with your current holdings, especially if you have already done an analysis on these positions and feel comfortable in them in the long period, no matter what the market says. Looking through the portfolio, the Nasdaq is up 6% in the last week, which reflects in my tech positions such as Apple and Microsoft. The overall market and S&P is up 4.4%, which again just reflects the bounce back that the market has been having over the worries of potential war situations calming down and positive news being released from the Fed, with interest rate hikes being lower than many investors priced in. Overall, I'm happy that I used this opportunity to buy into more positions I'm confident in, and I wished I could have put more money in. Due to my current situation, my outside capital is a bit limited. Leave your thoughts on growth stocks and some of these suggestions that I've made, and the companies and how you might look at them as investors. If you enjoyed, leave a like and subscribe for more business and financial related content and weekly full transparent updates on my portfolio.